Wall Street wants you to think investing is complicated, so you'll pay them hefty fees. They use terrifying jargon, flashing red screens, and complex mathematics to gatekeep the greatest wealth-building machine in human history. But today, we are tearing down the gates. Let me explain the stock market so simply that a fifth grader could understand it. You do not need a finance degree to build massive generational wealth. Let's begin. Before we decode exactly what a stock is, we must address the massive psychological barrier that stops millions of hardworking people from ever investing their money. The stock market has a severe branding problem, and it is entirely by design. When you turn on the financial news, what do you see? You see chaotic numbers flashing in red and green, ticker tape scrolling at the speed of light, and highly paid anchors screaming about derivatives, macroeconomic yields, and algorithmic trading. It looks completely terrifying. It looks like you are staring into the matrix. This complexity is a manufactured illusion. The financial services industry is a multi-billion-dollar machine. If they told you that investing was simple, you would do it yourself for free. By making the stock market look like quantum physics, they successfully convinced the middle class that they must hire professional financial advisors to manage their money. These advisors then charge you a seemingly small 1% management fee. But let me expose the math on that. A 1% fee compounding over a 30-year timeline will literally drain 25 to 30% of your total life savings and hand it directly to Wall Street. We are going to bypass the middlemen entirely. The core mechanics of the stock market are incredibly simple, deeply logical, and mathematically beautiful. You do not need to understand complex algorithms. You only need to understand the fundamental concept of business ownership. Let us completely demystify the machine. The absolute most important mindset shift you must make right now is how you view the word stock. Amateurs view a stock as a digital lottery ticket. They think it is just a blinking number on a computer screen that magically goes up or down based on luck. This is completely false. A stock is a legal physical reality. To understand it, look at the diagram on this slide. Imagine you want to start a massive, highly profitable lemonade stand. You need $1,000 to buy the lemons, the sugar, the wood for the stand, and the blender. But you only have $100 in your pocket. So you find 9 of your friends and you ask each of them to give you $100. In exchange for their money, you write them each a contract. That contract says, you now own exactly 10% of this lemonade stand, and you are entitled to 10% of all the profits we make forever. That contract is a stock, also known as a share. When you log into a brokerage app and buy one share of Apple or Amazon or Microsoft, you are doing the exact same thing on a massive global scale. You are not buying a flashing number. You are legally buying a microscopic slice of their massive corporate headquarters, their warehouses, their brilliant software engineers, and every single product they sell for the rest of eternity. You transition from being just a consumer who spends money to a legitimate business owner who captures the profits. A very logical question arises here. If a company is already highly successful and making millions of dollars, why on earth would the founders want to slice it up and sell pieces of it to strangers on the internet? The answer is capital expansion. Imagine a brilliant technology company invents a revolutionary new computer chip. The founders want to build 50 new mega factories around the world and hire 20,000 of the best engineers on Earth. That expansion will cost $10 billion. They have 2 choices. Choice 1, they go to a massive bank and borrow $10 billion. The problem is the bank will charge them astronomical interest rates, and that massive debt could easily bankrupt the company if the expansion is slow. Choice 2, they go to the public. They slice their private company into millions of tiny equal pieces. They offer these pieces to everyday people in a massive financial event called an initial public offering, or an I.P.O. By going public, the founders say, if you give us your raw cash today, we will give you a percentage of our company forever. The company gets the billions of dollars in debt-free cash they need to build their massive factories, and the everyday people get the legal right to participate in the future success of that specific invention. The stock market is essentially the greatest, most efficient crowdfunding mechanism ever invented for human progress. So, where do you actually go to buy these slices of companies? You go to the stock exchange. When you hear terms like the New York Stock Exchange, NYSE, or the NASDAQ, people assume these are mystical, highly complex institutions. They are not. A stock exchange is literally just a highly regulated, massive digital grocery store. Except instead of shelves stocked with milk and bread, the digital shelves are stocked with shares of Apple, Tesla, Coca-Cola, and Nike. Once a company goes public in that IPO we just discussed, the company has its money. From that point forward, the shares begin to float freely in the open market. The stock exchange is simply the centralized hub that connects millions of buyers with millions of sellers safely and instantly. If you own a share of Microsoft and you decide you want to sell it today to buy a new car, you do not have to walk around your neighborhood knocking on doors asking if anyone wants to buy a piece of Microsoft. You simply press a button on your brokerage app. Within milliseconds, the supercomputers at the stock exchange instantly find another human being or an institution on the other side of the world who clicked buy at that exact same second. The exchange takes your share, gives it to them, takes their cash, and deposits it into your account. The stock exchange provides total liquidity, meaning you can turn your assets back into pure cash almost instantly. Now we arrive at the question that completely confuses beginners. If a share is just a piece of a business, why does the price bounce up and down so violently every single minute of the day? The answer is the absolute most fundamental law of economics: supply and demand. The stock market is a live, continuous global auction. Look at the scale on your screen. Let us imagine a massive technology company announces that they just invented a revolutionary new artificial intelligence chip that will generate trillions of dollars in profit. Suddenly, everybody on Earth wants to own a piece of this company. There is massive demand, but there is a finite, limited supply of shares. The people who already own the shares are thinking, I'm not selling my shares for $100. This company is going to the moon. Because the buyers are desperate, they have to raise their bids. A buyer says, I'll pay 110. Another says, I'll pay 120. The price gets driven aggressively upward until a seller finally agrees to part with their share. The exact opposite happens during a panic. If a company announces a massive scandal, massive bankruptcy fears, or declining profits, suddenly everyone wants to sell. There is massive supply, but nobody wants to buy a dying company. In a desperate attempt to get rid of the stock, sellers start slashing their prices. They yell, I'll sell it for 90, 80, 50. The price violently crashes. When you watch a stock chart moving, you are simply watching a real-time visual representation of global human psychology and mathematical auction theory. You are watching the tug-of-war between the greed of buyers and the fear of sellers. So now you own a microscopic slice of a massive global company. How does holding this digital contract actually make you rich? When you invest in the stock market, your wealth is generated in exactly two ways. Mechanism number one is called capital appreciation. This is the concept everyone is familiar with. Buy low, sell high. You buy a share of a small company for $100. Over the next 10 years, that company hires brilliant CEOs, expands globally, and invents incredible products. Because the physical business itself has become massively more profitable and valuable, that legal slice of ownership you hold is now heavily desired by other investors. They are willing to pay you $500 for the exact same share you bought for $100. You sell it and capture $400 of pure profit. Mechanism number two is the ultimate secret of the wealthy: dividends. A dividend is pure passive mailbox money. When massive, mature companies, like Coca-Cola or Johnson & Johnson, make billions of dollars in profit at the end of the year, they don't always need to build new factories. They have excess cash. Because you hold the legal title of owner, they take a massive chunk of those billions, chop it up, and literally deposit physical cash directly into your brokerage account. You do absolutely no physical work. You do not clock in. You do not manage employees. The company's employees worked 40 hours a week, and part of the profit they generated was mailed directly to you, simply because you provided the capital. That is the definition of making your money work for you. If it is this simple, why are so many people terrified of the stock market? It is because society, movies, and terrible financial advice have completely brainwashed the public into believing a massive lie. They believe the stock market is just a giant, legalized casino. People think that buying a stock is the exact same thing as walking into Las Vegas, putting your life savings on a roulette wheel, and hoping the little ball lands on red. This is a catastrophic misunderstanding of economics. Gambling is what economists call a zero-sum game. It means that for you to win $1 at a poker table, another human being must physically lose $1. Absolutely no new wealth is created in a casino. Money is simply shuffled around in a circle while the casino mathematically drains a percentage of it away from everyone. The stock market is a positive-sum game. When you invest in the global stock market, you are funding real human innovation. You are giving capital to the most brilliant engineers, scientists, and executives on the planet. They use that money to invent life-saving medical devices, build more efficient electric vehicles, and construct global logistics networks that deliver food to your door. Because they are inventing new technologies and making human life more efficient, they are literally creating brand new wealth that did not exist yesterday. The entire global pie gets larger. In a positive-sum game, millions of investors can all become incredibly wealthy simultaneously, without anyone having to lose. You are not betting on a spinning wheel. You are betting on the relentless, undeniable upward trajectory of human progress. While the stock market itself is an incredible wealth engine, you can absolutely destroy your financial life if you play the game incorrectly. The most common fatal mistake beginners make is trying to pick individual stocks. Amateurs open a brokerage app, they read a headline on a financial news website, and they try to guess which specific company is going to be the next big thing. They take $10,000 of their hard-earned money and they dump it entirely into one single electric car company or one single retail store. This is where investing actually does become gambling. When you put all your money into one single company, you are taking on massive, catastrophic, uncompensated risk. History is littered with massive, seemingly invincible corporations that completely vanished. Remember Blockbuster Video? They dominated the globe until new technology rendered them completely obsolete overnight. Remember Enron? It was one of the largest energy companies on Earth, until the executives were caught committing massive accounting fraud, and the stock price went to absolute zero. If you put your entire life savings into one single stock, and that company files for bankruptcy, the value of your shares drops to exactly $0.00. Your money is completely vaporized. Furthermore, you must realize who you are competing against. You are trying to outsmart massive Wall Street supercomputers and hedge funds that spend millions of dollars a day on high-frequency trading algorithms. You cannot beat them at picking individual stocks. You will mathematically lose. To win the game, you have to completely change how you play. So, if picking individual companies is a terrible idea, how do you actually invest? You use the ultimate financial cheat code, the index fund. As legendary investor John Bogle famously said, "Don't look for the needle in the haystack, just buy the entire haystack." An index fund is not a single company. It is a massive automated digital basket that holds a tiny microscopic piece of hundreds of different companies simultaneously. When you buy one single share of an index fund, you are instantly diversifying your money across the entire economy. The most famous and powerful index fund in the world tracks the S&P 500. The S&P 500 is simply a list of the 500 largest, most fiercely profitable monopolies in the United States. When you buy an S&P 500 index fund, your $100 is instantly divided up. You immediately become a fractional owner of Apple, Amazon, Microsoft, Google, Visa, and 495 other massive titans. This completely destroys your risk. If one company inside that basket makes a terrible decision and goes bankrupt, you don't even notice. The other 499 highly profitable companies are carrying the weight. Furthermore, the index fund is a ruthless, self-cleansing machine. If a company inside the top 500 starts to fail, the algorithm automatically kicks them out of the basket and replaces them with a brand new, highly successful company. You literally own a permanent rotating roster of the greatest corporate champions in America completely on autopilot. When you combine the total safety of an S&P 500 index fund with a massive timeline, you unlock what Albert Einstein allegedly called the eighth wonder of the world: compound interest. This is the exact mathematical engine that transforms normal middle-class workers into multimillionaires. Look at the chart on your screen. Compound interest simply means that your money makes money, and then the new money that your money just made starts making its own money. It is a compounding loop, just like a massive snowball rolling down a mountain, picking up speed and size with every single rotation. Let us look at the undeniable math. Imagine you automate your finances to invest exactly $500 every single month into an S&P 500 index fund. You never panic, and you just let the machine run quietly in the background of your life for 30 years. Over those 30 years, the total amount of raw physical cash you pulled out of your paycheck and deposited is $180,000. But assuming the historical 8% average return of the market, your final account balance will explode to nearly $750,000. Over $500,000 of that final balance is pure, untouched compound growth. That is money you did not swing a hammer for. That is money you did not sit in a cubicle for. It is massive, life-changing wealth generated entirely by the relentless efficiency of the global stock market, working 24 hours a day on your behalf. If it is mathematically this simple, why do so many people lose money in the stock market? They lose money because they do not understand the psychological difference between volatility and permanent loss. When you start investing, you will inevitably experience a market crash. The news will scream that the economy is collapsing. The red arrows will flash on your screen, and your portfolio will drop by 20%. You must understand this absolute fundamental truth. A drop in the market is just a temporary, imaginary price quote. Imagine you buy a beautiful house for $300,000. The next morning, a completely crazy person walks up to your front lawn and yells, "The housing market is crashing. I will only pay you $250,000 for this house." Do you panic, start crying, sign the paperwork, and sell him your house at a massive $50,000 loss? Of course not. You would laugh at him, close the blinds, and continue living in your house. The value of your house fluctuated in his opinion, but you didn't actually lose any money because you didn't sell the house. The stock market is exactly the same, except the crazy person is standing on your lawn, screaming a new price at you every single second. When the market drops, you still own the exact same number of shares. A permanent realized loss only happens if you surrender to fear, log into your app, and manually click the sell button. If you refuse to sell during a market dip, the temporary volatility is completely harmless. In fact, a market crash is just a massive discount sale on the greatest assets in history. At this point, you might still feel a tiny knot of fear in your stomach. You might be thinking, "This sounds great, but I am just a very conservative person. I don't like any risk at all. I am just going to keep all my money completely safe in a checking account." I need you to listen to me very carefully. Cash is not safe. Leaving your life savings in a checking account is the single most dangerous financial decision you can possibly make. People think cash is safe because the digital number on their banking app never goes down. If you deposit $10,000, it says $10,000 5 years later. It provides a massive psychological illusion of safety. But wealth is not measured by the digital digits on a screen. Wealth is measured by purchasing power, what those dollars can actually buy in the real world. There is a silent thief in the economy called inflation. Every single year, the cost of rent, gasoline, food, and healthcare goes up by an average of 3 to 4%. If your money is sitting in a checking account earning 0% interest, you are mathematically getting poorer every single second of the day. Over 30 years, inflation will literally vaporize roughly 66% of your purchasing power. By avoiding the stock market, you are not avoiding risk. You are simply choosing a guaranteed, 100% certain destruction of your wealth by inflation instead of accepting the temporary, upward trending volatility of the stock market. You cannot save your way to wealth. You mathematically must invest just to survive. For generations, Wall Street executives in expensive suits have desperately tried to keep the stock market hidden behind a massive wall of confusing jargon and mathematical intimidation. They wanted you to believe that you were not smart enough to participate in the wealth generation machine without paying them a massive fee. That wall has completely fallen. You now possess the exact translation. You know that a stock is just a tiny slice of legal ownership in a real business. You know that the stock exchange is just a digital supermarket. You understand that instead of gambling your life savings on one single company going bankrupt, you can simply buy an S&P 500 index fund and instantly own the 500 greatest monopolies on Earth. You know that investing is not a casino. It is a positive-sum game where you hitch a ride on the relentless upward trajectory of human innovation. The only thing separating you from generational wealth right now is action. The best time to plant a tree was 20 years ago. The second best time is today. Do not let the illusion of complexity paralyze you for another year. Open a brokerage account, buy the index fund, set up an automatic monthly transfer, and let the mathematics of compound interest build your empire while you sleep.